Hello, my name is Tim Gregory. I'm from Vermeer Investment Management in the UK. I hope everyone is managing to stay safe and getting through this extraordinarily difficult time. Today, I wanted to talk a little bit about Japanese equities, which has been an area that Vermeer has been positive about for a considerable time and has had an overweight in our global equity portfolio since we launched the fund 3.5 years ago. We are structurally bullish about the opportunity for investment in Japan for a combination of reasons, which include a number of very high quality, world-leading technology companies that we strongly believe in. But alongside that, the structural corporate governance and reform-led drivers that we think will lead to a significant increase in shareholder value over the coming years. Now, we see this as a trend that's already started and has indeed been going on for quite a while, as managements have slowly shifted to focus more on shareholder returns alongside running their businesses. And we've also seen a number of activist investors beginning to be successful in engaging with companies and encouraging them to use the balance sheets that they have, which are very strong, in many cases, very high levels of cash and significantly underleveraged, to increase dividends, to buy back shares, to unwind a lot of the cross holdings that have been a negative for the Japanese market in recent years. Now, we don't actually hold a particularly bullish view of the Japanese economy. We fully acknowledge that it has been an economy of very low growth, low inflation for a very long time, and that the aging population and demographics continue to be a negative that is likely to overhang growth in the economy. However, Japan has got used to a period of very low interest rates, and we often hear now the term Japanification, meaning a way in which other Western economies, particularly in Europe, where we now have negative interest rates nearly across the board, and the US, where rates have moved very close to zero, as a factor that is becoming more and more the norm of low growth and very, very low interest rates. So Japan has been in this phase for a long time. And we see an ability to invest in the Japanese economy without actually having a particularly optimistic view of the growth rates that are going to come from there. We focus entirely on looking at companies where we see an opportunity for increased shareholder reform and better returns to investors and better focus of businesses. And alongside that, to invest in some of the great companies that they have in areas like factory automation, in the automotive industry, and their opportunity to continue to trade more with the Chinese economy, particularly as relations between the US and China continue to be difficult. And we can see Japan being a winner from this, particularly for their auto companies who continue to grow market share and benefit from the recovery we're seeing in China from the early stages of this year when the global pandemic really hit hard. So we're optimistic about Japanese equities. This is not set against a belief that the Japanese economy is going to do markedly better than it has done in recent years. It is purely a focus on the structural reforms that we see for companies and the opportunity to invest in some really strong companies that have a global presence. Thanks very much for your time today.